Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Today we are looking at 5 white moat Sharia compliant companies that dominate their industries and have a long-term compounding potential. Each one of these companies are undervalued at this point in time. These are not speculative companies. They have excellent free cash flow with predictable growth and strong fundamentals. What I'm going to do is I'm going to share with you guys the details of each one of the companies, and of course you will have to do your own research and make sure you understand how each one of these businesses work. When we talk about white moat, okay, you can pause the video and have a look at the 5 sources that built a white moat. For example, this information comes from Morningstar. Morningstar is one of the websites that I've been using for quite some time. So white moat companies rarely go on sale, but right now 5 exceptional stocks with durable competitive advantage are trading below their intrinsic values, and I'm going to share with you guys in a second. So switching costs is one of the things, network effects is another, intangible assets, a company with a cost advantage can produce goods and services at a lower price and so on. Efficient scale benefits companies operating in a market that only supports one or few competitors, limiting rivalry and so on. Each one of these things are factors that some of these companies do have. So if you're interested, I'll put the link in the description, but these are the 5 main things. Okay, so the 5 things that basically give a company a sort of a competitive advantage over their competitors. And what I'm going to do now is start with the first company. And the first one that we're looking at today is Linde. This is one of the companies that I've had in the portfolio quite some time ago. And I've sold it because at the time it wasn't doing much, to be fair, and the growth wasn't there. And I was a bit skeptical about the growth moving forward. But since then, it's done really well, but it's not as far, has not gone gone up a lot. However, in terms of the EPS growth and revenue growth, has actually slightly improved. This is one of the largest industrial gas companies in the world, and this company has 32 years of increasing that dividend. So the dividend yield basically is 1.4, and as you can see, it has a payout ratio of 36%. The latest increase was 8%, and the 5-year growth rate of 10%. Now, if we look at the in terms of free cash flow side of things, $5 billion is closer to 200 billion market cap. So it's a huge company. $5 billion of free cash flow is absolutely amazing. And like I said, in terms of profitability side of things, management are doing an absolutely great job. And right now, as you can see, they're expecting the earnings to grow about 9% revenue, about 5%, but 10% upside from where we are. If we look at Seek and Alpha, and if we look at basically what's happened to the company in the last year to date, for example, is only up 1%. So it hasn't done much, to be fair, this whole year, and it has a current PE, forward PE about 26, and for the 1 year it's actually down about 6%. If we look at the earnings expectations moving forward, this is the information that I've just shared with you guys, and as you can see, they are expecting almost that double-digit growth for EPS and revenue, that about that 5%. Now, if we look at the fast graph, for example, this company hasn't been, to be honest, normally if the price, which is that line on the top there, is below this orange line, that means the company is actually undervalued at that point. But it has not been there since 2008. Since then, it's been actually going up every single year, and it's done absolutely amazing job in the last, I will say, in 2024, and now it has come back down quite a bit, but is not to where it's supposed to be. So if we look at the performance for this company over the last, since 2004 against the S&P 500, this is the total return, 12% against that 9% of the S&P 500, and that dividend is growing fast, which is quite nice to see. So the total dividends they received was about 13,000. The growth of basically the stock that they so that 10,000 has become 97,000 since 2004. So if you had invested in the companies 2004, right now you would have 110,000 US dollars that of that 10,000 that you've invested without reinvesting that basically dividends every single year. So it is really good company, and is Is one of those companies that done really well, but right now trading below that intrinsic value. The next one is a Colgate. Colgate is one of those companies that we know their products are available in every single household. Own some of the world's most recognized brands, Colgate-Palmolive and soaps, and so many other toothpastes, and so many different products that we normally buy without even thinking about. 63 billion market cap right now. Dividend is 2.6. It's probably one of the highest. It's been the highest I think it's been for quite some time, in the last 5 years at least. The payout ratio is only 56%. The latest increase of 4%. The 5-year growth rate of 3%. It's a little bit disappointed that 3%. I don't like that. That should be at least 6 to 7%. But it is a great company. It is one of those companies that you buy in for your portfolio just in case you want the lower volatility, and just like, you know, you get your 3%, 2% something dividend every year. Grows a little bit. It's not great, but it's one of those companies that will keep your portfolio safe. So you get your nice dividend, and if you are closer to retirement, probably this is probably one of the best companies out there for sleep well at night while you're getting your dividends. 62 years of increasing that dividend, so they are dividend a king. This one is a dividend aristocrat. This one is a dividend king, and 90% safety, which is quite nice. The payout ratio is quite low as well, 56%. Now, if we look at the profitability side of it, one of the best out there, $3.4 billion of free cash flow right now, 5% EPS growth, 3% revenue side of things, 12% upside from where we are. And if you look at the year to date, it's almost 14% down. Currently, it has a forward PE of 21. If you look at the earnings expectations moving forward for this one, it's about, you know, that 5%, 6%, which is what we normally expect from this company, 3-4% when it comes to revenue side of things. So nothing to scream about, but it's just it's okay. It's doing okay, and that's what we expect from this type of business. Historically, this is where, you know, it's been 2008, 2009. It was basically undervalued. Since then, it's been going up every single year. And because this is the type of company that is in almost in every single ETF or index fund out there, that's probably one of the reasons why it does well, really. And any dividend paying an ETF, it is in there. Okay. Now, as you can see here, the performance over the last since 2004 against the S&P 500, it hasn't actually overperformed the S&P 500. It has underperformed 7% against that 9%. But in terms of dividend side of things, it's done actually well. So if you invested $10,000 in 2004, right now you will have about $42,000. And if we look at the forecast expectations, you know, what we expect from this company moving forward, look at the estimates. Right now, you would be losing a little bit of money if you actually invested in that, not living, but about 16%. If we use the normal multiples for this company, which is that 25 or whatever PE, you would be making about, you know, 16 total annualized rate of return. I just realized we didn't do the same thing for the last one. So let's have a look at Linde when it comes to the forecast side of things. If we look at the estimates, again, the estimates is always basically unrealistic for some companies, about that 15 PE. But the company has been trading about 29 over the last whatever years. And if you bought the stock right now, based on that, your 10,000 will become about 13,700. Now, moving on to the third company that we're going to look at today is FICO. Fair Isaac Corporation is one of those companies that has done really well over the whatever years, and is the company behind the FICO credit score. And whether it's like or whether we like it or not, this business is deeply embedded in the global financial systems. Over 90% of the US lending decisions rely on FICO score. So it's one of the companies that some people hate it, some people love it. But as you can see here, it's about 16% undervalued at this point in time. It's about 41 billion market cap. And as you can see, profitability side of it is doing really well. I don't like the fact that it doesn't have excellent free cash flow here. So we got 40 billion market cap, and right now we're just less than $1 billion of free cash flow. That's ridiculous. I really don't like that. But they're expecting the earnings to grow about 36% and 22% for revenue side of thing. So it's growing very fast, just even better than some of the technology company. It is a tech company anyway, but is doing better than some of the big boys out there, which is interesting. Although it's a credit rating sort of a company, it uses a lot of data, of course. And if we look at the basically year to date, 13% down for the 1 year, 26% down 40 PE forward PE of 42, which is absolutely crazy. And look at this. Historically, the company's been doing really well. 2018 start, and from there onwards, it's been going up and up every single year to the point. What was the highest it's been? The highest has been about 2,300, and since then is down about 26. So about your 10,000 would have been 7,000 something right now if you bought it a while ago. Now, if we look at the performance against the S&P 500 over the last whatever year since 2005, basically you double in your money if you like. They don't basically pay any dividends. And then forecast moving forward, if we use that normal estimate of that 24-15 growth expectations in terms of EPS, now if you look at the normal multiple, okay, by the way, if we go back here so quickly, sorry, if we're using that, and basically you will be losing some money. Of course, as always, that's normal. 42 PE is basically where it's been, that is, which is really crazy if you think about for the company, but it is growing fast. So I don't know if it's worth it, but right now, if you bought the company, it will be about 13,800, that your initial investment of 10,000, or if you want to total rate of return of 38%, which is quite nice, right? And the next one that we're going to look at today is another company that's very similar to this one here. Is one of the largest credit reporting agencies in the world. Like FICO, its moat comes from the massive data network that it has. And as you can see here right now, 25 billion market cap. They do have some dividends, but they haven't actually been increasing or anything like that. But the latest increase was 28%. So let's see how it goes in the next couple of years. Profitability is decent. It's got better free cash flow, which is quite nice, to be fair. 25 billion, almost half of basically the market cap, but it's got slightly better free cash flow here. 17% in terms of EPS expectations for next year, the growth side of things. Revenue about 8%, 29% upside from where we are. And a year to date is about 19% down. For 1 year, it's about 21% down, which is interesting. Now, that forward period about 27, and if we go here, as you can see here, since, if you click the summary, again, another one that since 2011 has been going up and down, is very cyclical, to be honest. So this is what Mr. Market likes to trade this company. It's been below that, and basically 2018 it was actually cheap enough, and then it's gone up, and then it came back in 2020 because of COVID, and then since then it's been up and down every single year. So it is very cyclical business, and it looks like it is coming back down again. So it'll be interesting to see. Now, performance side of things, since 2004, the company has done basically about 11% almost. So your 10,000 invested in 2004 would have been right now 81,000, including that dividends, which is quite nice to see. And if you look at the forecast moving forward, estimates about 15-20 sort of. Right now, if you bought this stock based on that, you will be losing about 12%. Or if you bought this stock right now, you'll be losing about 1,300 of your money. Now, if you look at the normal multiples, as you can see here, okay, if you bought this stock based on that 31 PE, and you think it's worth that much, total rate of return will be 61%, or your 10,000 will become $16,129. And the final company we're going to talk about today is UPS. UPS is one of those companies basically most people have forgotten about. Wall Street do not want to touch it. 80 billion market cap. It still has a wide moat. Prices are right now 95, so it's coming back a little bit. Dividend yield of closer to 7%, 87% when it comes to their payout ratio. I wouldn't be surprised, to be honest, if they cut it, and I wouldn't really care if they cut it right now in half, so they can focus more on that, basically use some of that cash to buy back their own shares and things like that. 15 years of increasing that dividend. 50% is the safety right now, so which is not safe. So that's one of the reasons I say they might cut the dividends. Profitability is decent, excellent free cash flow. Expected to grow earnings about 4%. Revenue not growing at all, which is interesting. About 18% upside from where we are. And if you look at the year to date, for example, is down 24%. For the 1 year, 27%. Current forward PE is about 14%. If we look at the earnings expectations, just to show you again, this year was a write-off completely. Next year, about 4%, about 11% after that, which is interesting. So it's nicer to know that things are improving moving forward for the company. And then revenue is again write-off. And then next year, about almost a 4%, then 5%, then 4%. So again, it's basically the expectation for the company moving forward actually looks decent. And as you can see here, it's very cyclical business, okay, over the last whatever years. And then if you look at the performance side of things, okay, so the cheapest it's been, it's probably around now maybe. But if we look at the performance side of things over the last whatever years against the S&P 500, absolutely 2004 up until now about 3%, which is ridiculous. But that dividends is actually 9%. I think the highest it's been, even you can see it from the price side of things, was during COVID. So around 2020, it basically was around here to then it's gone up to almost, you know, $217 per share, and right now we're looking at less than 200. So COVID was a good time for the company. Very cyclical business, and the total performance does not look great over the last 10 years, and we will see what happens in the next few years. It has excellent dividend and actually has been growing that. So I'm not sure what's going to happen overall, but let's see what happens. In terms of estimates, so that 3% in terms of EPS, and then about that 11% in 2027. If we're using that right now, that 15 PE, but right now, if you bought this stock right now, you'll be making about $4,000, which is quite nice to see. And then the normal multiples for this one, which has been about that 16, you know, almost a 17 PE. If you bought the stock, you'll be making about, you know, your 10,000 will become about 15,500. So you can't really lose a bit either way. So it looks like it is coming back. It is decent company, and because now they no longer, you know, partnership with Amazon and so on, their margins should start improving. And if that improves, inshallah, hopefully, then the EPS and everything else should start increasing. I like the fact that they got excellent dividend, free cash flow, which I would love them to use to buy back their own shares instead of just increasing the dividend, reduce the shares, which will help us long-term investors and so on. And from Sharia compliance side of things, these are where we are. This one, I normally use so there are different ways of doing this, okay? So, you know, when you're basically doing the interest-bearing debt, you have to divide this by 12 months or 24 months and 34 months, 36 months, or otherwise you're going to lose a lot of money, because if you use the 24, basically every single year, some of your companies will be in the red, some of the basically non-Sharia compliant become Sharia compliant because they follow the market cap. So this company is down quite a bit. For that reason, the company have not taken any more debt or anything like that, but because the market cap has come down, the debt level stayed the same. That for that reason, this has gone up. So what I normally tend to do is I use 24 or 36 months just to make it, because as a long-term investor, you cannot be using that 24. It makes absolutely no sense. Otherwise, companies like, for example, I do have companies, this one here, for example, the business is still fine, but because the market cap basically has come down quite a bit, so even if you look at the last 3 months, it has come down quite a bit, and for that reason, it became non-Sharia compliant. But if you use the 24 or 36, it's absolutely fine. There's nothing wrong with it. Anyway, let me just quickly show you one of the companies that I own. UPS is one of my worst performing. $3,000 pounds in the red right now, but I do not own, I think I don't own any of the other companies. Nope, I don't. But this one is interesting. I might actually start buying back a little bit of this one every single week and see how it goes. FICO is a great company. I don't like this side of basically the fact that free cash flow isn't where I want it to be. And again, I do have other companies like, for example, S&P Global, MSCI, and so on. So I don't want to buy more of similar sort of sectors. So I'd rather buy S&P Global, more of that, than actually adding FICO to the portfolio. But Linde is probably another one that's very attractive right now. It's below where I actually sold it, so I might potentially include it in the portfolio. Anyway, I hope you're enjoying the content. I hope you like what we're doing here. If you do, please join us at the Patreon account where you get access to a lot of things. Have a wonderful day. Assalamu Alaikum.